Do you hate the thought of working past 55 or 60? Do you hate not being able to live the life you deserve today? Do you hate not knowing what your financial future looks like? It's time to stop doing what you hate. Here's your host, Mr. Harold Green.
Hello, everyone. This is Harold Green of Bright Tree Wealth Management, and it is time to stop doing what you hate. Hopefully, you're having a great day today. I'm excited to be sharing with you an update on the stock market. First, I want to get into my week. It was a hard week. It was a tough week, but I'm glad I made it. And it's one of those weeks where you just got to be thankful for everything that you have and the people that are in your life and all the blessings that you have. And just then when things aren't going right, just need to focus on the good. Focus on the good that God is doing in your life and not all the negative stuff that is being thrown at you. And so I think I've turned the corner. Not sure yet, but anyway, I will, because that's what happens when you keep moving. You will eventually turn the corner. But I want to get into today's show. It's a stock market update. So, I have a disclosure. All investments do carry risk of loss. Past performance is no indicator of future results. So are you going to invest, got to understand your risk tolerance, time horizons, and then make sure you create a trading strategy that's centered around a well-balanced, comprehensive financial plan. And then if you work alone, I would tell you, maybe go out and sit down with somebody that's a professional, get their 2 cents on it. And then if what they're saying makes sense, if you're doing the right thing, continue on it. But if you're not doing the right thing, you might want to get some professional help. And so I want to get into the stock market update, but just to help you understand a little bit more of what my mission is, it's to get people out of the 97% into the 3%. And if you're a client, thank you very much for being on board with us. And thank you for referring people in. You're part of the team. We're all in this fight together to not only get you and yourselves to the 3%, but to help as many people get out of the 97% as possible. And I'm going to do a show next year about the haves and have-nots, and just kind of give you some insights into some of the things that people do to sabotage their success. And I'm excited about that. But I want to get into this current stock market update. Are you ready? 1, 2, 3, let's get it. It's been a crazy year. It's the end of 2024, and I like to say the dates in my show so we can just kind of look back on it in the last 3 or 4 years, see how things have gone. But I'll tell you what happened with us this year. Our firm started with about $52 million in assets, and we've doubled that to over $110 million. And that does not include monies that people have come on board and given me to manage for them. This is pure growth. And that's about 100+% return. And, you're like, how did you get 100% return in the market? And it was hard. It was really hard. But what we had to do is we had to stick to our beliefs, and we had to stick to our strategy. And we just had to drown out the noise. And there was a lot of noise in 2024. I mean, a lot of noise. You had the election noise, you had inflation noise, you had interest rate noise, you had all kinds of noise, tariff talk noise. I mean, this stuff is crazy. Mortgage rates through the roof. People can't buy houses. It was just insane. But then you had people traveling, enjoying their life, doing the things that they want to do because they have gotten themselves to the position where they can do that. So we're living in a bifurcated economy with the haves and the have-nots, and it's always going to be like this, and it's going to get even worse. And so if you're out there and you think you're in the 97%, and you want to get to the 3%, I want you to listen very carefully to what I'm saying in today's show. So we had winners this year. We had losers this year. The winners were Palantir, Tesla, Bitcoin, EME, CEG, JP Morgan, BMA, which is a bank in Argentina. And that was crazy, 200-something%. And you're like, 200-something, like, wow, in a foreign country, like how did you see that coming? I'll give you a little update on that. MicroStrategy, Costco, T-Mobile, Walmart. And if you're sitting there and buy and hold, and one of the things I tell people, it doesn't matter who the president of the United States is, unless you're in a buy and hold portfolio, then it matters a lot. But if you're in an active managed portfolio, you can seek the opportunities that each president either creates and trade on that, right? So if they hurt one sector with their policies, look for the sectors that are going to benefit on the opposite side, and then you place your trades over there. That's what we do. It's an active managed portfolio. You will pay over 2% for that. But if your portfolio is up 30, 40, 50%, and you're crying about 2%, you will be in the 97%, especially moving forward. If you are not careful, and I'll say that if you are not careful, if you're smart and you have skills, you can avoid that. But if you're not, you're going to end up being very unlucky. And the losers were like Energy, Nucor, CVX, NVO, TLH, Lennar, Home Builder, Starbucks, Coffee, Intel, Rocket Mortgage, Devon Energy. I mean, there are a lot of losers out there. There were more losers than winners out there. And if you're in one of those things where they say, well, just buy the stock and hold it and never sell it, if you're holding the wrong thing and you're waiting for it to come back, you could be sitting there losing out on 30, 40% returns while you're holding something that's down 10 to 15% just because of what you believe and how you feel about stuff. And that's what got a lot of people in 2024. I saw that a lot. And I was golfing with a friend, and they're also a client, and and they lean one particular way, and they were like, yo, this Trump guy is stupid. And I can't stand the guy, but my portfolio is doing really well. And I said, yeah, take the money, take your wins, and don't worry about that other stuff over there. I know that's an emotional thing for a lot of people, but if I'm sitting here trading your portfolio based on how I felt about a particular president, I need to be fired. I'm hired to drown off the noise. I'm hired to deal with all the emotional stress and anxiety that you folks don't have to worry about. Look for the right opportunities and go at it. And that's how we're able to get to grow the assets. And that's not all of our assets. That's just one particular platform that we use. We have several other platforms that have grown drastically as well, but it's just too much information to go dig out and talk to you about. But it's all relatively up quite a bit. Between some platforms are 40%, some platforms are 100%. It just depends on what's allowed on those platforms. Some platforms don't allow us to trade stocks and options. Some platforms only allow us to trade mutual funds. And even with mutual funds, we're up big, because what I did is I looked at the mutual funds that had the top holdings that I wanted and that I trade around on a day in and day out basis. And if they were top heavy in those positions, I bought a lot of those for those clients on those platforms, and that's what we did. But one of the things, and these are several things that we have to look at on a day in and day out basis, but this year I had to pay close attention to some others that I normally don't pay attention to, but this year, boy, I had to. And one of the things was mortgage rates. And if we look at the mortgage rate history going back, I don't know, 10 years, say 2014, in 2014, mortgages were down to 4.31. That's the average mortgage. 2015, 3.99, 2016, 3.79, 2017, 2018, and then 2019, it got down to 4.13. But in 2020, it got down to 3.38. And then 2021, it got down to 3.15. In 2022, it skyrocketed up 2.5% more in 1 year. And then 2023 went up to 7%. And then 2024, it was 6.9%. I'm just going to say that was a bad decision overall. Whatever people did, they made a bad choice at that point. And it did not work out for the market at that point. The choice that was made did not, and honestly, I don't care, because we did well. And for us, like I said, for your portfolio, it doesn't matter because we're actively managing it. But if you're in a buy and hold position, this sucked, because now you can't refinance your house because the rates are too high. You can't take equity out and do the things you want to do with it because the rates are too high. The industry was just like stuck. And if you look at that, houses weren't moving. Then, Home Depot's not moving. Tractor Supply is not moving. Restoration Hardware is not moving. People are just stuck. They're not turning over their houses fast enough. They're not buying new supplies to remodel. It was stuck. And so I avoided all of that, really did. I also avoided a lot of energy positions because energy trades for us was an in and out thing. We didn't stick to it too long because I knew it was just a complete disaster. And honestly, that's what's driving up the inflation is energy cost. That's my personal feeling, and that's what I see. You look at car insurance, that's part of the services, transportation. That's a large part of inflation, and a lot of that is not going to come down. So food costs are up, shelter costs are up, all these costs are up. And so if you bring down the cost of energy, you'll bring down the cost of shipping those goods and services to the consumer. So I believe that's going to bring that part down. But then we also had to look at bond yields in terms of what investors are willing to pay the government to buy their debt. And so with more government spending, people needed a higher yield to buy the government's debt. So bond yields started spiking. Started the year off, bond yields being at, but this is 10-year 3.7. It got up to April 4.54. Then after that, they started talking about rate cuts and different things like that. Then it went down in September. And then right before the election, we started hearing about this tariff stuff, tariffs. And then bond yields spiked. They spiked up to 4.5. You had the Fed come out talking about tariffs and inflation. And then we had a PCE number that came in lower than expected. And, it's a lot of noise. Okay. And so we looked at that and said, all right, well, we're going to keep our foot on the gas in certain positions. We're going to take profits, which we did on several things. Then we look at the GDP outlook for next year, and they're talking about it being somewhere around 2.8. And it looks like they're anticipating 2.4 in 2025 and then 2.1 in 2026. To me, this is a pretty negative outlook. This is saying that the economy is going to get bad. The economy is going to cool off. Some are anticipating the economy cooling off, and some are anticipating an explosion in productivity and growth in our country due to companies onshoring more production, onshoring more assets, looking at different tax breaks to corporations to onshore. And that's got a lot of people in the private sector very, very giddy about it. You're looking at some potential deregulation in the banking sector, some deregulation around crypto. You can have a lot of stuff, and that can be a very positive outlook for the market. And so when you look at it, one of the things you have to look at is the geopolitical outlook in terms of what's happening in the world around us. And so there's this guy in Argentina that I've been following. Okay, his name is President Javier Milei, if I said that right. And he had this crazy idea to come in and just start chopping government spending, chopping. And over the last year, inflation, I would say back in April, inflation was up at 292% in Argentina. That's pretty bad. That is pretty bad. So when you look at these countries and you look at their leadership and you look at, okay, what are people clamoring for? People are clamoring for lower regulation. They're fighting for more of their own economic freedom, and they want leaders who are going to come in and be smart enough and get the job done. This guy's an economist. They elected an economist as president of their country. Like, how smart was that? They didn't hire a politician per se. They voted for an economist. Like, when is the last time we ever had an economist running our country in the United States? We have a bunch of politicians that like to waste money and say that they're for the people. And I'm not want to get in trouble by saying that, but there's a lot of unnecessary spending. Look, if I was your financial advisor, I saw your books, your cash flow, and I said, hey, you're spending too much money and you fired me. Aren't I hired to be objectively non-biased when it comes to managing your money and looking at your overall best interest? Am I not supposed to be objective? And I can't be afraid of telling you that you're spending too much money, especially if you're spending more than I can make you, or you're spending more than you make yourself. But these guys elected an economist. And the BMA, which is the bank in Argentina, they exploded to the upside because this guy went in and started chopping stuff. He's gotten inflation down. In November, it's down to 166%. I can't wait until they get it down to whatever their target is. Who knows what Argentina's target inflation is? I haven't studied it that deep. But if I can look at that and say, okay, this is what a leader with an eye on economics can do for a country, I think that we now have a leader with an eye on economics, sans all the other crazy stuff that comes along with it. All right, because there's some crazy stuff that comes along with this person. just like every other leader, there's stuff that comes along with them. They all have their baggage. But how do we benefit off of that? Well, we look at the industry that they're talking about fixing, the things that are broken. So this new person is talking about fixing energy. Well, that remains to be seen. And so I'm not going to jump in with both hands and both feet buying energy or buying options on energy stocks, because that is going to take a while. That could be a 2-year materialization in that trade. It could be 2 years. There might be an immediate bump as soon as that person takes office. There's always a bump on hype, just like they did with crypto. Now it's falling back. There's a hype on a lot of stuff around that, Trump being elected, but then it's going to fall off. And so I'm always careful of hype trades. we ride the momentum until it stops and then we get out of it. Because if you're sitting in there holding it, thinking the momentum is going to come back, well, the momentum could change and go into something totally different and you could be left behind. But rotating is going to be the theme of the upcoming year. Rotating out of some stuff, rotating into other stuff, and then just watching the trends, and just kind of seeing where things are starting to head. It's kind of like when it rains and then the river gets full and then it's going to overflow. Then where's that river going to go next? Where's the overflow going to go? And we want to go there and put our buckets out there in order to take advantage of that. Now, again, there's no guarantee on this stuff. All investments do carry risk of loss. But these are some of the things that we're going to be watching. I'm also going to be watching for tariffs next year. If the tariffs and the fear of tariffs don't materialize, right? If none of that comes to pass and it doesn't hurt the economy, I believe we're going to be in a very solid position. Inflation, we're going to be watching that to see how much further it comes down. Interest rates, the Fed is saying they're only going to cut rates 2 times, but we're getting inflation numbers that are coming in lower. So the market is seeing one thing, that the data that the Fed is getting is saying one thing, but the Fed is saying something different than the data. Like, that doesn't make a lot of sense to me. I don't work for the Fed. I'm not one of their economists. So I didn't go to college to become an economist. I don't study the economy like they do. I just see the numbers in the investment strategies, and I see the returns in the market. I see the cash flow of corporations and different things like that. And then I hear what the Fed is doing and I see what the Fed is doing. And so that sometimes is a bit of a head scratcher, but again, it's all noise and you have to have a noise filter. And that's what I want to tell you. And so going into this year, if you look at your assets and you look at your situation and you say, hey, man, I'm still in this doggone 97%. I might be in the 98, or I might even be up in the 50% now, but I want to get to the 3%. Give us a call, get on the schedule. Let me do an overview with you to see if there's adjustments that we can make in your situation to help to expedite you to the 3%. And that's why we have the rapid retire financial planning process, right? It is designed to help a person potentially knock 4 or 5 years off of their retirement number. In some cases, 10 years off their retirement number. So if you're looking at 65, we want to see if you can get in position to retire at 55. It just depends on how late you are in the game and where you are in the game and how much assets you have to bring on board and what we're allowed to adjust and to change. And for a lot of people, what I've done over the past year is I've changed my strategy for the new clients coming on board. And some of them, they don't know me that well. And so I have to, they know of me from referrals. They've heard what I've been able to do through the referrals. But some of them, once they come on board, if I full on gas them, like if I give it all the gas I got, these portfolios can get extremely volatile. If you say, hey, Harold, I'm high risk and I gas it for you, and then you lose 10% in a day, and then you freak out and I say, hey, you're 99. So, if we gas it, you might be down 10% today, but you might be up 30% at the end of the month. That's just, it's volatile like that, depending on your risk score. So some of the portfolios are on low risk, some are on medium risk, and some are on high risk based on where you are in the overall process, right? And so I want to be able to take a look at that for you and see what we can do. But I'm excited about what we've done this year. I'm excited about the opportunities we have next year. We're gonna tread lightly. We're going to tread lightly. We're not going to be stupid about it, but we're going to tread lightly. And we're going to continue to focus on growth, and just supernatural growth. Whatever great growth we can get, we're going to focus on that. But we're also going to be very careful and judicious about how we operate. So thanks again for tuning in to today's show. Until next time, 1, 2, 3, let's get it.
This is the podcastfactory.com.